a bear market now, or do you think this is still a cyclical bear phase in a structural bull market?
Hi, Sonia. Thank you for calling on me. I'll just start by telling you two small quips. First is, we always believe that every crisis represents an opportunity. So there are hidden opportunities lurking even in the markets today, and hopefully, as analysts, we'll be able to unearth them. But let me tell you a better story and introduce some levity into otherwise very serious atmosphere. You remember in the 1980s, Ronald Reagan, who was then President of America, was assassinated. And then as he went to the hospital, his wife joined him, and he looked at him from the hospital bed and said, "Honey, I'm sorry, I forgot to duck." I think the bulls forgot to duck. There's a rampage that is coming our way in the financial markets, and he forgot to duck. I don't think it's to be taken any more seriously than that. I think for some reason markets have become extremely psychologically nervous, and these are all interlinked. If you ask me about China, and you ask me about oil, and you ask me about interest rates, and you ask me about earnings in India, I think there's reason to be optimistic rather than pessimistic. So I'm somewhat surprised. Markets tend to do these things once in a while, get completely panicky. But the smart investor knows which stones to turn and how to profit from this crisis. So, that's my short take on it for whatever it's worth.
Okay. Morning, Ramesh. Thanks a lot. It's always good to have an experienced veteran, calming voice at times like this. So thank you for joining us and taking our call. Would you say that this is the time small investors should start nibbling in? Today, you will see, if there's any sense, the DII should be a buy number.
I've been saying this 2 months ago, that I was nibbling 2 months ago. So clearly I've been wrong. So having admitted that, I've been doing the mea culpa. Let me just take you, what they do is for them to decide individually. But let me take you through some of the situations that the markets are panicking about, okay? Let's take it, for example, oil. Oil is going down, so people are looking upon it as a malaise, that growth is probably going to slow down. But that is typically in this phase of the market when all news is treated as bearish news. You could also say that to oil importing countries, US, India, Great Britain, it's an unmitigated positive for us. I mean, the market chooses to see the negative and not see the positive. The kind of consumer benefits that flow from lower oil pumps in the US will be incredible. Of course, the oil energy sector will be saddled with bad loans, but that's in the private sector, so that they deal with that crisis from all time to all time. And in India, if we let the prices fall at the pump and let the retail enjoy a benefit from it, I think that would help us greatly. Let's talk about interest rates. I think we don't really care if the interest rate is 25 basis points or 50 basis points. You don't base your investment decision based on a 25 or 50 basis point. What you want is a trajectory. Is it going to go much higher, and how high is it going to go? I think the Fed, under no circumstances, is now, given the volatility in financial markets, going to raise interest rates 4 times in 2016. I think, in fact, in the next few weeks, if this kind of mayhem goes on, they'll probably reduce rates. So I don't think that's an overhang on the markets. Okay. Let's take China briefly. The big thing is China is slowing down. But this is a global world, excluding China, which is $60 trillion worth of output. And China is accounting for only $2 trillion worth. It's a big amount, but it's not going to overwhelm the world economy. Sure. And to come back specifically to India, if you look at it anecdotally, some of the early results are being much better than expected. It's just the market is knocking it down, whether it's Asian Paints, whether it's Reliance, whether it's a few results coming down. I think they're going to be better. We are going to earnings season with the market going down, but expectations very low. But earnings are going to reflect better than the reality.
Yeah, but Ramesh, the counter question to that would be, good morning. The counter question would be that, just in bull markets react positively to bad news at times. Is this now a market which is reacting negatively to the best of the earnings? And in that case, as Sonia pointed out and asked you, is this a question of this being, a bit of a bear market right now, where the price damage could be much more from here and capital preservation could be the better theme?
That is always, of course, the million-dollar question, and we don't know that. But, my experience, tells me that while there are some signs of, the market reacting badly to negative news, bearish sentiment prevailing, there's nothing broader in the economy to suggest that, the boom that started in 2013 is over. It's a gut-wrenching correction. But I think when the dust is cleared and settled and we've gone through a normal week or two, I think you will find that investors who bought in this panic, will tend to get superior returns. I mean, I have, very little doubt about that. I'm not saying that you go buy today, will the market go down tomorrow? Probably it will. But my experience has been that you don't try and time the market, you spend time in the market. The trick is to find a great business and invest in that, not to buy any stock that people recommend on television or radio or newspaper. It's going to go up, multi-bagger. So today, I think that doesn't make sense to me. What makes sense is, you look around and say, who is going to benefit from this new economy? Is our defense orders coming through, our road orders coming through, our cement dispatches increasing? You want to look at those kind of businesses that, financial inclusion, digital businesses, that will benefit from the economic environment in the next few years, and you're getting them at sale prices now. So, I'm not at this point in my career or in the stage of the market going to hang my head and say, I'm going to liquidate my portfolio and get into cash. I don't recommend that. Maybe it suits some people, but I feel you maybe raise some cash if you have no cash. But other than that, I think if you are an intelligent investor, you need to be looking for, great stuff cheap. It's just crazy to trade the market technically. I think no one even gets this. You have to look at it technically, but you have to base your decisions based on whether the underlying fundamentals are strong in a business. And if it gets cheaper than you buy it, then have the courage to step up to the plate and buy some more. That's all there is to it.
Yeah, Ramesh, until now I have been staunchly resisting Anuj's comparisons of this current sell-off in January to the 2008 period, to September 2008. My point was that there is no Lehman around the corner. So, why these comparisons are uncalled for. But now we're getting increasingly statements of those who foresaw the Lehman crisis. For instance, Bill White, the economist from OECD, now saying that there is an avalanche of debt default waiting to happen across the Western world. And now the central banks have no ammunition. These arguments, do you think, should prepare us for a slightly longish period of this, bearish sentiment?
It could. I'm not, whether what happens in the U.S. is a separate question altogether. The subprime crisis was once in a 100-year tsunami that took place. I think the oil, energy, and the high end, it is owned by private companies. And there's bankruptcy protection laws in America. They have to work themselves through it. Hopefully the government won't, meddle in that too much. But I can only speak to you a bit more knowledgeably about India. I think we are heading to a period where, interest rates are going down in India, or I think Rajan will reduce them over the next quarter or so. Say oil prices is an unmitigated boom for India. We're just kind of missing the point. And I think corporate earnings, starting from this quarter that we're talking about, anecdotally at least I'm saying, from what I talk to my analyst friends, a lot of companies are going to report much better than expected earnings. We've already seen some straw evidence of that taking place in companies like Reliance, taking place in Asian Paints, and in a few other companies. So, I'm saying that, it's always at the point of maximum doom that, the pessimists have the saying and they feel that, the earth is going to fall down. But in my 30 years, I haven't seen that happen. I've seen that intelligent investors can always pick bargains and reap the rewards 6 months or 1 year down the road. I'm not saying that it's going to have a V-shaped recovery and tomorrow everything will be all right. But, I find plenty. Plenty of good businesses to buy at this point.
Okay, you have definitely brightened up our sullen mood this morning, Ramesh, at least mine. But, I wanted to take a follow-up question on that important point you made about corporate earnings. You spoke about Asian Paints and Reliance. There's a long list of other large caps that have done very well this time, whether it's Infosys, whether it's Zee Entertainment, Kotak Bank, some of the non-index large caps like LIC Housing, Oberoi Realty, etc. Do you continue to put money into these names now, or do you think that because of the perhaps time-wise correction that this market could go through in the quarters to come, maybe it's better to wait a little bit, maybe a couple of months before putting in fresh money?
See, I think the various ways in which an analyst will look at the question, I think the fear that even some of the bulls have, for example, is that foreign selling will continue unabated in India, and hence prices will go down. And while that's true, I think people need to remember that for every seller there's a buyer, right? Shares aren't sold into a pit, for example. For every share of, ONGC sold, someone has turned to be a buyer out there. What we've seen over the last year is that domestic investors stepped up to the plate, and they were buying and countering the FI selling. Clearly now the tide has turned against them, and it's the FI selling that has taken over. But I think Indians know the country best, and when they see, the stocks that they know and they like getting to be bargain levels, they will step up and buy. I think the Indian equity cult that was drawing about $1 billion a month into mutual funds probably is stalled for right now, but I don't think it's stalled permanently. I think people will come back and buy. So whether there's foreign selling or whether there is markets are ultimately slave to earnings. And if the economy shows some signs of pickup, I think people come and step and buy in petrochemicals and media and entertainment or whichever sector they choose to. So, the idea that you can make risk-free returns is not there. If you want to make risk-free returns, go to a fixed deposit.
What if the reverse happens, Ramesh? What if, the FI selling continues and even the DIs or the domestic money starts to throw in the towel? I mean, in stock markets, we have to talk about all probabilities and all risks.
Then you would be right, the stock would go down. But my feeling is that, smart money is smart money, and they'll be intelligent. They'll realize that, these companies are available for song, and they will step up and buy because economic prospects of India aren't that bad. Of course it can happen. Of course everyone can decide to sell, But, these things don't happen. Markets work on difference of opinions. And people have different opinions on how a company is going, how a trajectory of an economy is going. And if do any sane analysis, you will find that, the economy is doing much better. Can the short run? Yeah, it can happen. Of course it can happen. I'm not going to say the market won't be down another 20% tomorrow. Yeah, it can happen, But, is it a likely probability event? I somehow don't think so. And I'll be proven wrong. It could happen. But I would like to be proven wrong first. And I'm not going to get into that panic mode. I mean, 3 months ago, you can all cheerlead for the Indian economy, cheerlead for stocks, have conferences where people discuss stocks, and suddenly in 3 months, we can turn so bearish and say, oh God, nothing is available in India or nothing is cheap. I mean, it doesn't make sense. It's not what the gravitas of an intelligent investor. Intelligent investor tries to find things that are cheap, great businesses, and the economic environment that is, conducive to business growth, which we are finding in India today. So I'm saying that, stocks, Phil Fisher said it, common stocks, uncommon profit, If you want to make a better return than fixed deposit, you have to put your money out there and have to take the risk. I mean, there are always people who will say, oh, the Dow will go down to 5,000 or this will happen or that will happen. But the stock market is a story of the triumph of the optimist, not of the pessimist. Sensex has compounded at 18% for the last 30 years. I mean, that's the fact. You can't dispute that fact.
Well
Without
said.
dividends, I may add.
Okay,
Well
we're just trying to be realists, right? I mean, there's no point being an eternal optimist in a market like this. But Ramesh, one final question from my end. Last year the theme was in mid caps and small caps, and there was a lot of money that people made in mid cap and small cap mutual funds, where some of these funds gave you 20 and 30% returns. But now when you look at the NAVs, these stocks have fallen 30-40%. Do you stay put, or do you move some of your money out of mid caps and small caps and back into the large caps?
Sonia, it's a difficult question, and I think, to be honest, I've been at fault of that. I kind of missed the huge kind of excesses that were going on in the small cap and mid cap space. I tend to invest in them more prominently than the large caps, and I was finding my companies are doing well. The earnings will be better next year than this year. The growth will be superior. So I was kind of in that middle of complacency, if you will. So it's a difficult question. I mean, with especially large caps also having fallen so much, but I truly like to believe that I am cap agnostic, that I want to buy a great business. I'm equally comfortable buying someone like Hindustan Lever or buying a small mid-cap company. We just want to find great businesses, well-run, good returns on capital, good business environment. So, my answer is, I don't know what every mutual fund is doing in this country, what kind of business they're investing. But if you're investing directly in the market, which is something I know something about, I just go out and find a great business. And, time is a great friend of the great business. It will make it much better, make your returns much superior out there. You have to give it time, and sometimes the greatest opportunities in life present themselves in some sort of, meltdown that, in my opinion, is partly unjustified.
All right. Ramesh, it's been a pleasure listening to you. Thank you very much for introducing some much-needed sanity into stock market investing. Trading is something else. Thank you very much for joining.